This chart looks at investment-grade corporate debt, or debt that ratings firms consider pretty safe. There's a lot of it out there right now. Over the past decade, companies borrowed more and more as interest rates hovered near zero. Now, analysts are concerned. That's because about half of that debt, or $3.7 trillion, is rated BBB, the lowest rating investment-grade debt can receive. And some are worried this debt isn't as safe as the ratings suggest. Companies that make well-known products, like Campbell's Chicken Soup and Elmer's Glue, have had debt rated BBB. Analysts say the debt could be a mess in the making, especially if the economy enters a recession. To understand why investors are concerned, you need to understand how corporate debt is rated. Think of these ratings as credit scores for corporations, but instead of using numbers, ratings firms assign letter grades from A to D. The higher the grade, the less likely the company is to default on its debt. Each one of those ratings is broken down further into triple, double, and single letter categories. So, AAA debt is safer than single A. BBB debt sits just above an important dividing line. Everything above this line is considered higher quality, investment-grade debt. Everything below is considered risky or junk debt. It carries a higher risk of default. The worry is that if the economy takes a turn, some BBB debt will slide into junk territory. A key metric for how these ratings are assigned is leverage. Leverage is a ratio of how much debt a company owes compared to its earnings. The more debt a company has relative to its earnings, the higher the leverage. It's an important factor in determining how safe a company's debt might be. Since the financial crisis, companies have a lot more leverage. In 2009, corporations had a little over twice as much debt than earnings. By 2019, that ratio had increased to about 3 times earnings. And when you just look at BBB-rated debt, that ratio is even higher. This is what's concerning investors and analysts. They say that in the past, companies with this amount of leverage would have been rated in the junk category, which is far riskier. This has caused a divisive debate over whether this debt will cause big losses when the economy turns.
Business debt has clearly reached a level that should give businesses and investors a reason to pause and reflect. If financial and economic conditions were to deteriorate, overly indebted firms could well face severe strains.
For their part, ratings firms like Moody's and S&P say other factors also play a role in assigning ratings. Having a solid brand and generating sufficient cash flow to pay bondholders can also influence a company being rated investment grade. Ratings firms make predictions about what a company's leverage ratio will look like in the future. For highly leveraged companies, these predictions can serve as a deadline to keep their investment grade status. If a company doesn't hit its target, it runs the risk of being downgraded. But the amount of time some BBB companies have been given to meet these deadlines has left some investors scratching their heads. In 2018, Moody's said the BBB rating for Campbell's Soup was too high after it acquired a snack company for $6.1 billion. It estimated the company's leverage had topped 5 times earnings. Moody's gave the company until July 2020 to get it below 4 times earnings. Ratings firms predicted Newell Brands, which makes Elmer's Glue, would reduce its debt load for multiple years. When BBB-rated Newell announced a multi-billion-dollar acquisition in December 2015, S&P and Moody's analysts predicted its leverage ratio would fall from more than 5 times to under 4 times earnings by December 2017. They continued to make similar predictions that Newell would be a safe bet in 2016, 2017, and 2018. But these 2018 calculations failed to account for lost earnings from businesses Newell had sold. At the time, Moody's said its calculation was just a different way of measuring leverage. An S&P spokesman told the Wall Street Journal that our analysis speaks for itself. Updated calculations from both firms showed Newell's debt was above 5 times earnings at the end of 2018, revealing that the bonds had been a potentially riskier investment than what the ratings firms indicated. S&P downgraded Newell's debt to junk status in November. Moody's still rates it BBB. But investors still remain skeptical. More than $100 billion in investment-grade debt is trading with yields that are usually associated with junk debt. These bonds are rated BBB-, the absolute lowest rung of investment-grade debt. The Federal Reserve raised the alarm about the volume of outstanding BBB debt in November, saying that widespread downgrades during an economic slowdown could disrupt the liquidity of the corporate bond market, potentially leaving investors in a sticky situation.